Welcome back, my passive income investors alike. Today we are going to have, but not a fun conversation, something that has been hitting really personally close to home, and it comes down to three perspectives that I'm going to be discussing in this video. And a lot of this is going to be relating to Meet Kevin's video, because Meet Kevin posted a video where he quote unquote quit, a little bit of clickbait, because he's just stopping doing the morning streams because he doesn't see the point analyzing stocks minute by minute on morning open and close, when his short-term to mid-term thesis is that the entire market is going to go through a correction period because of inflation getting out of control. And we're going to round back to that conversation when I get some points that I want to discuss out of the way, because I'm going to discuss a lot of how I see what I'm doing with my portfolio and just generally what I feel within this current market. But these three perspectives come down to primarily short-term thinking. And a lot of people in this group, like myself, are extremely young. And we've got decades ahead of us to ride downturns and upturns, and I don't really care what happens in the macro personally. However, I am dealing with the second perspective, which is the short-term aspect of it, guys, because obviously long-term would be first. Second is short-term, because I'm watching my parents go into a retirement phase. And when I have to broaden my view down to not have a long-term passive income investing lifestyle where your time horizon is greatly reduced to retirement, and now you're hitting that point in your life, the perspective that you're taking a look at is going to be a lot more comparable, in my opinion, to what Meet Kevin is doing, because you really have to take risk tolerance into perspective against the current environment of this market, which is very hard to wrap your head around in this current environment, right? And then the third perspective is what happens after you're done, because eventually, guys, it doesn't matter how hard you work, how hard you save. I have been hanging out, unfortunately, with friends that have terminal cancer, and when you listen to what they had planned out for their life, it has greatly been reduced to a much shorter time period. And all of these perspectives have to come into play in your life to some degree, because if you live to too much of one extent compared to another, it's not going to be like the funnest, right? You don't want to hermit your life and not spend any money and try and save to retirement to unfortunately have your life cut much shorter. So these conversations are hitting me rather impactfully lately, because it's crazy how I have to deal with every aspect of this. And you start really thinking about what you're doing in your personal life, and it's kind of scary. So first and foremost, guys, let's talk about this kind of short-term perspective. What is going on with the risk in the market? Because I feel like we're still kind of stuck in this intertwined perspective of people think that things are just going to be okay. And I constantly reiterate this, but if you are not prepared to see a 30 to 50% correction in your stocks at any given moment, you should not be buying individual stocks. And that is easy to say when the markets are up, but I don't think people truly appreciate that until something like Facebook drops 30 or 40% and reality kicks in very fast, which is something that obviously happened to me, right? So on that aspect of things, when we're talking about hyperinflation, guys, I am really concerned in the macro. Everywhere I look right now, I am seeing less and less bullish signals. All the top large tech companies, except for the ones that didn't offer guidance, are in the single digits for the first quarter and likely into the second quarter of the year. So if we're not going to be boasting 20% revenue growth and you're not seeing that, there is no reason for these companies to be trading at 50 times multiples. That's what's causing a lot of the volatility, obviously, in the market. Now, long term, I think we're going to get through a lot of this. I greatly appreciate the long-term perspective, because I encourage any midterm to short-term dips, because that's where we cost average in. That's where we take advantage of our time horizon. But when I'm looking at my parents living in Toronto here outside of the city, and I'm looking at real estate, every single piece of property selling for 30% over asking. I just looked at a $1.5 million, or it was a $2.5 million property. It was a fourplex, sold for over $4 million a week after listing. I'm looking at properties listing for $900,000 an hour and a half out of Toronto, selling within a week or two, 30% over asking every single time. When you take this environment of rents being exceptionally low in a period where we're seeing hyperinflation, and it's exciting for a lot of oil investors out there watching gas skyrocket, but considering how much inflation has already hit this market, gas is one of the biggest impactors along with real estate, because if real estate skyrockets, inevitably rents have to go up with it. There can't be a disconnect correlation between the skyrocketing real estate market and rents, which is scary, because if rents go up, inflation goes up. If gas goes up, food prices, housing materials, every aspect of the economy starts going up even more, which leads to the fear of what Meet Kevin's talking about, that when you're seeing supply constraints, oil, and all this stuff come into play, and prices inevitably continuing to skyrocket to these 7 to 10% inflation rates, the Fed is going to have to react a lot harder than most people are probably anticipating. And that leads into the second scary aspect of the market, because if interest rates decide to go up more rapidly, guys, it is going to turn the real estate market into one hell of a wonky roller coaster, because a lot of people that are buying real estate now, locking in low rates, they're going to go into a period where they'll never sell those homes because they're going to have to take on a higher rate. So they end up getting stuck where they are. And then on top of that, guys, if real estate corrects because of the hyperinflation and all these problems and interest has to go up higher than anticipated, now all of a sudden you just purchased a $1.2 million property, you put 15 or 20% down, and now all of a sudden you're 30% underwater on the mortgage because the property dropped that much because of the hyperinflation and interest raising environment. Now, this is all macro thinking and it's all speculative. We do not know how this turns out. But when I'm looking at my parents and I'm looking at what would stabilize them and give them the best rate of return, I am utterly fearful of how do I invest correctly? How do we find the right people to invest for them? How do you get a financial advisor and look at divesting your portfolio in a way that protects you against that downside risk? Because when your time horizon gets cut to zero, you can't really not help but look at the macro environment and take those risks into consideration and invest accordingly and try and get the right cash flow. Because unfortunately, the real estate market goes, the banks go with it. Every aspect of my portfolio, I see excessive risk continuing to go up, like every aspect. I don't care whether it's the logistics and like shipping part of the portfolio, whether you're talking large caps with Amazon, Facebook, which are now kind of coming into the slowing down period. And a lot of people think just because the stocks have dropped, I always remind people stocks can always go lower. Now they can also go higher. Nobody knows what happens because historically, even in recessions, markets do pretty well. And I'm not telling you to go full on meet Kevin and liquidate your portfolio, because by no means that's nothing that I've done here, right? But it's a hard discussion to be had, especially with what we're seeing right now, right? And C North is saying immigration into Canada last year, 400K, only 25K houses built. Yeah, so it's really kind of wrapping my head around, and that's why I'm having a glass of wine right now, by the way. You got to relax a little bit. But taking this stuff into consideration, guys, talking about the long-term perspective, because that's the time horizon I have, what I suspect is the volatility is going to persist this year, and I think we're going to see a lot more of it. And it's not going to get better from every aspect of the market. I think we're going to see crazy ups and downs in real estate, crazy up and downs in stocks. It's going to be all over the board. But I still think that we are in one of the greatest growth cycles we're ever going to experience. I still think once we get through some of these hoops and hurdles of these short-term pains, that the market is going to go through this technological shift greater than we've ever seen in our lifetime. Sitting on your hands is going to be the most stupidest thing you're ever going to do if you got 10, 20, or 30 years to invest, because I'm telling you, and I said this before, we're not going to go from internal combustion engines to electric vehicles to all of a sudden something else. We're not going to go from the current banking system to blockchain technology and smart contracts to something else in your lifetime. We're not going to see the utility grid upgrade to deal with the electric vehicle onslaught and everything going battery powered. That's not going to happen again in your lifetime. So I can't foresee the next 10 or 20 years being nothing short of one of the greatest growth and innovation periods of our life. I mean, they're putting pig hearts. They finally genetically modified using AI, machine learning, genomics, guys. All of that is finally coming to play to actually get the first person to accept a pig heart as a human organ transplant. Now they're going to try it with kidneys, and they're still playing this out because they don't know if it's going to fully take on. But that guy's like a month deep into a new heart and he's still alive. This shit is going to change our lives. It is going to extend life expectancy, right? Like there's a lot of interesting things going on in the market. However, guys, having the kind of money that I have in the market right now, like I said, I got sideswiped by Facebook, and it kind of smartened me up a little bit because, again, I don't think you truly understand your risk tolerance until you get slapped upside the head. And I have spent literally the last 2 weeks divesting and diversifying my portfolio to moderate, reasonable things. I can no longer be looking at growth and tech companies trading at like 8 to 10% of my portfolio because it's just far too much risk. Now, don't get me wrong. I actually bought a lot of my Facebook back. I've been pivoting around different accounts, topping up retirement accounts, and primarily looking to get my dividend yields of about over 10%. Many of you know I've been buying stocks like Pfizer on the dips. I've been adding to index funds to offer more stability. And I honestly think index funds are a great place because if the market tanks like I'd hope it would, because I encourage downturn trends, because that's when you're likely to get rich, because you're going to keep working, you're going to keep investing, right? But when you can utilize some of that short-term volatility with index funds and kind of get away from it, when those markets drop, your index might drop 20 or 30%. But I guarantee you it's not going to drop as low as PayPal or what Shopify is dropping or any of those aspects of the market, right? So you can take advantage of index funds. And even if you're going to take a loss on it, you can still get more growth potential when you see your favorite dividend stocks drop or whatever. Now, I'm not saying that's going to happen. There's no guarantee that's going to happen. The markets could keep going up. I don't know what they're going to do. I am just trying to talk more pertainably about what you need to do with your risk tolerance. You really need to understand at the scale of your portfolio and the time horizon you have if you should really be invested in three stocks, and if you could handle those three stocks perhaps dropping 50%, and are you willing to ride that out for 3 to 5 years? Well, perhaps the market keeps going up. I mean, the S&P 500 is still up and PayPal is down a substantial amount. That is a hard thing to stomach. And I think people say it's easy until it happens, right? So again, when I'm going to probably do a portfolio reveal tomorrow, but I'm trying to continue to diversify based off the earnings reports that come out. And I have to sit through earnings because this is by far the most pivotal earnings season I've ever listened to. And I really think we're in a dominoes effect when Q1 hits and we start seeing Amazon actually start yielding only 3% growth, when Apple finally has no choice but to show what's going on. Google, they all shied away from guidance. That scares me a lot considering the companies that did offer guidance. And there's no way one is better than the other. I just don't see it. When you boat all that in, guys, with hyperinflation and like crazy spending, I still think we're in one of the greatest job markets that's ever existed. People are making money hand over fist, but that is not keeping up with the inflation rate if this gets out of control. And if they make any crazy interest rate hikes, it's just going to make things a hell of a lot more confusing for your investing lifestyle. So for me personally, the way I've done this risk tolerance is I've weighted nothing more than 5% of my total net worth in my stock portfolio. I divested Facebook down. I actually ended up buying it back to reweight it up. I re-leveraged Tesla down a little bit. It's still the largest position in my portfolio. I think it's like 5.5, 6%. I've been trimming Apple down. I trimmed Microsoft down, and I only position them into mostly index funds. I'm looking at even scaling Ryokan down here because I've come to realize you don't know what you don't know. And I get highly fixated on individual investments, but that doesn't make them better than another investment, right? Like I look at Ryokan, is really awesome real estate investment trust. I love with my entire heart, but I could obviously compare it to something like Smart Centers, which is almost the exact same comparable company. Both of them have done just fine. Both of them have continued to yield great dividends. Like if you picked one or the other, it wouldn't have made any difference in your financial life. So I've realized that there's no point for me to take on excessive risk with one investment when I can divest it into another great company that has the same prospects and just get rid of that volatility risk while increasing the cash flow. Because my new prerogative for at least the next 3 to 6 months until I kind of see what's going on with earnings, I don't make predictive decisions based off what Meet Kevin is doing. I don't know what inflation is going to be like from 6 to 12 months. I don't know what interest rates are going to do in 6 to 12 months. The only information that I can invest on is what companies post. And like I said, when I'm listening to Amazon, Facebook, all my favorite companies, guys, the vibes that I'm getting from it are a lot different than they obviously were 6 months ago. So I have to take that into consideration if you're going to be over leveraging in companies, right? Especially these companies that are still trading at extremely high multiples. So on that note, I still have my list of growth companies. There's a lot of stocks on my list. And the way I'm going to start moving forward for the next 3 to 6 months is primarily cash. I'm getting my dividend weightings up, trying to get to about 10,000 annually. I'm going to be taking those dividends, guys. I'm primarily just going to be reinvesting them into good companies. Like I'm either going to be continuing to add to healthcare, which I'm underweighted on with things like Pfizer, but primarily parking them in index funds for at least the next 3 to 6 months. That's where most of my attention will be. And then what I'm going to do is primarily for my working income is just stack cash until I see how this plays out and just kind of get a feel out for this market, because I don't know what to do, and I don't want to be aggressive at the scale of my portfolio. Now, if you're newer to the market, I would just cost average. I mean, and this is just an opinion. Don't take it as financial advice. I'm just in a much different position than I was 7 years ago. And obviously, if I'm just investing and I got 5 or 10,000, I would be highly aggressive still. I would be throwing in after my emergency fund and maybe just a bit of cash in case the markets take a wicked dip. I'd be cost averaging it every single month. But at the scale of my portfolio, I need cash to be at a certain weighting to take advantage of a major dip. Because if I've only got 5 grand in my pocket right now, guys, and the market corrects 20 or 30% or the vast majority of my stocks, that 10 grand is not going to do anything for me. It's not enough cash to actually like reweight the bottom part of the market, or at least cost average into it at the down periods. And I'm not going to lose money here with the scale of my portfolio, putting 10 to 15% into cash, or at least getting to that. I'm not selling stocks to put cash. Keep that in mind. I am not paper handing the market. I'm not selling into cash and just parking it away like me, Kevin. I'm still 100% in this market. It's just the capital that I'm making moving forward. I'm going to digress a bit with it and just park it for 3 to 6 months and build it up. If nothing happens, the market stabilizes, the markets go up, great. I'm not losing anything here. I still take advantage with the mass, 370K portfolio that I have in this market. I'm just, like I said, I recognize the short-term risk because I'm forced to look at it. And I think if any of you have parents going into retirement, I can't imagine that you're not having the same concerns or issues, because it's impossible to predict what's going on. But the volatility and the wonkiness, is unsettling, right? And I also need to realize that I want to start going out again and I want to live a little bit because I'm telling you, man, when you have people in your life that watch their time horizon get cut down to years, when they had long-term visions and perspectives in their life, it's enough to make you cry, feel really uncomfortable, and it's just sad all around. And like, then you're setting up your life for your family's future as well. And I hope people kind of take all of those perspectives into consideration in their investment time horizon. Cause I noticed Dave Ramsey gives you a percentage of your portfolio to invest. He usually says about 15%. The reason that he says lock in a percentage rating, because you want to enjoy life. You want to take some of that cash. You want to travel. I've never regretted one trip I've ever been on. I mean, I blew thousands of dollars traveling. I've never looked back and said that was a waste of money. I've gotten great learning experiences, seeing family in Brazil, traveling all over the place, Mexico, whatever. I want to go watch the rocket ships take off in Texas, watch some of those, Starlink satellites, or maybe the next big Dragon launch, and just kind of see what's going on with sending people into space. Like that stuff is interesting to me, and I want to take advantage of that as well, right? So like I said, I'm in a much different position than most people. I'm going to pass it off to you guys. We can talk a little bit about some Q&As here, and then I'm going to kick off. I just thought this was a very important perspective because everyone batters Meet Kevin a lot. He's a very macro trader, and I get where he's coming from because I'm starting to recognize a lot of these risks. Because when you're not getting 20% growth numbers, guys, you lose that cushion of growth. Risk becomes ever more prevalent based off those price to earnings multiples. And now, don't get me wrong, a year or two from now, I think we're going to go back into an incredible growth period, or maybe even 3 years. I don't know what happens. I just feel like the future's coming quicker than people could ever anticipate. Doesn't mean we're not going to go through some short-term periods of pain. And this is all driven by one particular thing. And I knew this was coming. This is what happens when you turn the printers on, guys. This is what happens when you print trillions of dollars and 40% of the US money supply, and same thing here in Canada, and you offload it into the market to people that don't deserve it. I'm sorry. I lost my entire career through this pandemic, but I would gladly give back half of my stock market returns to go back to the market we had 5 years ago, because it just doesn't make any sense, right? Like, you can't offload all this free capital into the market. This is the negative side effects that we are now witnessing based off a lot of factors. And it is what it is, right? We got to enjoy the grace of pumping the markets to the moon. A lot of us made a lot of money. I feel bad if that wasn't you. But unfortunately, if you've been through that period, you now have to recognize that we're getting shit out on the other end of this. And that's going to be volatility risk and a lot of confusion. And I'm just worried, guys. We can't have gas and real estate doing this every single year. It's going to absolutely destroy, and it's going to put the Fed in a bad spot. It's going to lock their hands, and we're going to go back to the 1980s. We're going to go back to interest rates that could be jumping up multiple percents a year, a few percents, double-digit percents. I don't think we'll get to that point, I hope, but there's no guarantee. Nobody knows. There never has been. There's no guarantee in life. Walking across the street is risk. It's the sad side of it. So I'm going to pass this off. What was your career? I was a full-time magician for a decade. I was a full-time entertainer. I worked with my business partner that ran a DJ company. I'm actually still looking at doing some work with him because we still get some major clients that are coming back. Like, we actually get to do the primary audio work for the Royal Bank, which is the largest company in Canada. I get to introduce the CEOs, do some MC work. It's a lot of fun. And he re-invited me back to do some of those perhaps, which I wouldn't mind doing because I just think it's fun. But yeah, I can't go back to that career because it's complete bust. Unfortunately, the balance sheets of restaurants, cruise ships, places that I worked will take a while to rebalance. And obviously, I'd rather focus on a career that's going to stabilize my income and, protect me and allow me to stack cash rather than have to compete for work in this terrible environment for entertainers. I went bankrupt, man. My entire career, I watched $24,000 worth of contracts dry up over a month. What do you think about Intel? Intel's an interesting one. I like the chip maker still if you're looking to cost average into some chip makers. I wouldn't buy NVIDIA per se. I'd have to look at Intel. I know it's one of the more better valued ones. I want to see NVIDIA crash. I love NVIDIA, but it's hard to wrap my head around the valuation. Just like Tesla is. I like Tesla a lot more than NVIDIA. So if I'm going to take on the risk, I'd rather pick my personal preferences. Get a job, man. Lots of work out there. 100% agree, man. 100% agree. Right now is the best time to ask for a raise or get a job. I mean, I'm making 6 figures a year at my new job, so I'm not really too concerned about it, to be honest. But I am concerned about, gas going up to where it's going up, food prices going up to where it's going up, real estate going up 30+% a year in a market where they're already worth millions of dollars. I mean, that does not bode well. And that is an unsustainable risk factor. Yeah, I know life sucks, very unfair. Yeah, life isn't fair. It's unfortunate. So you kind of just take the cards you're dealt and don't compare yourself to others and work yourself in your own position. This is why I can't tell you guys what to do or invest. Everybody's on their own different perspective. Do you use CDRs for US stocks? Absolutely not. I do not like owning. I've talked about this before, guys. If I'm buying US assets, if I'm buying Chinese assets, if I'm buying European assets, I'd always rather get the cash flow or the dividends or own the stock in its native currency. I will never try not to own foreign stocks outside of their own native currency. I know it's a headache to set up, but I really like having my US cash flow come in as US dollars. I don't like converting currencies. I don't like the CDR market in Canada. I don't like owning VFV. If I'm going to buy US stock, I'm going to buy it with US dollars. I'm going to get paid in US dollars. I'm not converting it to CAD. There's definitely a disconnect between wage growth and real estate. It's not just real estate. It's seven to 10% inflation rates. I mean, put this in perspective. The real estate market in the last 2 years has over doubled here in Canada. It's literally over doubled. Now, for just look at my perspective. I've been investing for a while. If you went back to March 2020, I had $100,000. Today, I have almost 400 grand. That largely is because of this rapid pace of market growth. Now, the next person, if that's you, you're just starting out investing, guess how much harder you're going to have to now work to afford the same house, the same stock, the same anything. You're going to have to work 30, 50, 100% longer and harder. That doesn't bode well for the economy, guys. People are having kids later on in life. People are living with their parents longer. All of this is going to impact the market in not particularly a good way, in my opinion. Um, a humble brag. Yeah, I will let me have my humble brags, man. I worked my ass off to get to where I am. I mean, I literally work ridiculousness to achieve what I've achieved. I've been very diligent. It's not like a brag or anything. I know, sorry, man. It's all good. I'm not like calling you out. I've been having people in the comments lately because I show my rate of return open and honestly, and I'm just getting so much criticism about like I'm bullshitting or this or that. And people are calling me out because they're like, oh, well, you have more money in your TFSA than your return says, because if you had that kind of return, your TFSA would be worth more. And I'm like, you can't make a return on money you just contributed. I'm like, if I made 100% return on Tesla, I made 100%. If I dump 10, 50,000 in my account the next day, that doesn't change the fact that I made 100%. I mean, it doesn't reduce the return. It just makes it harder to make a bigger return because now I'm investing new capital that also has to go up. What does the tobacco companies like MO and the honestly, for the short term, I love tobacco companies. For the long term, I do not, because people are smoking less and less. And that seems to be a compounded growth thing that's going on. But at the same time, like if you have a shorter time horizon or you're looking for cash flow today in an environment where there's more stress, people have to work harder. I mean, when I looked at MO's earning in the midst of the pandemic, it was the first time in almost 10 years that's the percentage of people smoking didn't drop. It actually flatlined during the pandemic. It was a really interesting fact. But then as soon as we got to the other side of the pandemic, things cooled down a little bit. All of a sudden, it went back to accelerating to a down period. Now, I think MO's got like at least a 10 or 15-year time horizon to get their shit together. I'm just really concerned because they're like MO particularly. I do like BTI. I would rather take Philip Morris or something over that because they have international exposure where I feel like perhaps the international markets are a little bit more inclined to smoke. Because unfortunately, in the US, if you look at MO, they're getting hit with headwinds left, right, and center. Every investment they've made has been a complete catastrophe, from Jewel to Kronos Group. It's honestly been one of the worst management decisions I've ever seen from a company that I thought had a lot of experience in litigation, which clearly their experience means nothing. They've done a horrible job wasting billions of dollars, and they're living off the cash flow they have by increasing the price of cigarettes. So their business model, in my opinion, is dying. Even though you look at the numbers in the books, it looks great. I don't think the bottom line business is doing that great over the long term, but because they're so big, they're going to be fine for at least 10 or 15 years. And in these more cyclical downturns, I could see them doing even better. And I like them. If you're looking for cash flow, short-term stability, I think they're great for downturning markets and just somebody that's looking for, 6 to 8% yields where they're going to be for sure reliable. I would go to those markets. Just avoid MO. I personally don't like it. I'd rather go with the broader diversified companies. I mean, recently MO tried to partner with Philip Morris because after Jewel fell out from under them, they partnered with Philip Morris to do IQOS. And guess what happened? The government blocked them from that partnership. They can't get ahead no matter how hard they try. It's a complete disaster from that aspect. So I don't like MO, obviously, but my personal opinion, you might have a different one. I'm bullish on the second half of the year. Yeah, I'm way more bullish on the second half. I was watching Millennial Money last night, and I noticed that I think Andre Jake made a really good point that this market would be a lot easier if the Fed just talked to us like we were children. And they just literally said, hey, guys, if this happens in the market or we see this from this data point, here's what we're going to do. If this happens, Here's what we're going to do, and just lay the framework so we understand how the Fed is looking at what's going on. Because when they explain stuff, it's really confusing. It's kind of passive in nature. We don't know their full plans. So I don't like when, when Jerome makes bold statements about like, oh, if we have to do this, we're going to do that. And it's just like, if you could talk to us like we're children and just give us a framework that a child could digest, I think the market wouldn't be so volatile against what the Fed's doing. Stock banks in Canada, what do you think? Stocks are great. I've been buying them. I bought actually Royal Bank today. I think in this market, interest raising environment, banks go up. Keep in mind, however, because banks are highly leveraged into the real estate market, I am concerned from the risk side of it that if the real estate market decides to flip for whatever God knows reason, which I'm really concerned about. You guys know that when stocks go up 30%, 50%, 100% again and again and again, it's unsustainable growth. And that's what real estate is doing right now. I am terrified for that reason, but I still love banks here. I'll still take that risk on to a reasonable percentage. I think overall, banks in my portfolio make up about 17% right now. And I own Bank of Nova Scotia, Royal Bank I bought today, Toronto Dominion Bank, and Canadian Imperial Bank. I prefer them over US banks personally, but that's again just my prerogative. If you're interested in HC, you should check BMY. Yeah, those are good too. Cool. I buy TD Bank. I love all of them. BMO's great. BMO's been just crushing it because the oil market's going up, largely exposed to that sector. National Canada or the Canadian National Bank's another great one. I love all the Canadian banks. I wouldn't own one of them individually. I'd rather own them as a basket. So instead of buying the ETF, because there's only a handful of bank stocks, maybe just take 10 grand and just go 2 grand BNS, 2 grand CM, 2 grand Royal Bank, and just own the basket of them because it's dumb to buy them in an ETF because there's just too few of them. And considering I still think the Canadian economy is going to grow rapidly from a population standpoint, they need banks, they need telecom. So I still like banks, but you have to understand when they're running up like this that there is some exposed risk, but I don't mind buying them here. I still like them. Think CAD's banks are okay here. I would just dollar cost average over the long term. That's what I've done, man. I completely agree. I don't think you should just lump sum into the banks. You got to keep in mind, I've been holding Bank of Nova Scotia now for 6 years. I mean, I've been holding these banks for a very long period of time and I still buy them. I sold Apple in the March 2020 dip to buy the banks. And then I bought more banks over the last few weeks. BCE Bell Inc. is a great one. I love the telecom. Personally, I like TELUS a little bit more, but maybe own both. I do like Bell for cash flow. I think it's a good company. I don't know it as well because I've been hyper fixated on TELUS, which I bought more of over the last couple of weeks. TELUS gives you exposure to the healthcare sector, which I like because they have large investments in telehealth, kind of like Teladoc, right? But you're owning this really stable company that deals with internet, obviously like mobile devices and telecom. Which I really, really like. And do you like, yeah, I'm a lot actually. I scaled down Northland Power and I upped my Algonquin Power position. The utilities don't tend to do well in an inflationary market because they're highly leveraged. Typically real estate, anything that has a high amount of leverage, I could say telecom too, typically don't do that well when interest rates go up because they usually leverage capital. I've noticed that recently, Algonquin Power, TELUS Corp, I've noticed they've been doing share dilution over taking on debt, which I'm not sure I'm the biggest fan of, but to some degrees I get it. So, I mean, they're okay, but I don't expect them to do well in an interest raising environment, but they are stable for cash flow because Algonquin Power, you're getting water utilities, you're getting infrastructure utilities like Hydro One, where you're just getting transmission lines, you're getting the renewable sector, you're getting natural gas. I kind of love it as a stabilized cash flow machine. But like I told you guys, I don't buy utilities and I primarily don't buy REITs for growth. I try and buy ones that I think are going to grow, which is why I'm kind of looking at Canadian Apartment Properties Trust, but I don't want to buy them presuming that they're just going to go up. I'd rather purely just say, hey, if I'm buying this for the next 5, 10 years, I just want to focus on the cash flow they produce and make sure that cash flow is reliable because that's what I'm using to reinvest elsewhere. Can you make a video about CNR or CP? Is CNR Canadian National Railway? Yeah, the railways are interesting. They never really boated to my attention, but maybe I could make a video on them and maybe do a deep dive analysis because they do offer a lot of stability. I think people forget that over a lot of other shipping methods, people don't realize that you can only ship certain items by train. When we're talking about large chemicals that they're transporting across the country, it's too dangerous to do it by truck. So they actually have contracts with trains that are very foundational. So I think there's a lot of that's why Warren Buffett bought into the railways, right? Because they just they own MFC. Like these guys, this is funny, man. Everything you're mentioning here are stocks that I'm literally talking about with my parents right now as they kind of look for a retirement diversified portfolio. And many facets of the market. I mean, we're talking about annuities to everything to bonds to private mortgages. Like we're looking at really diversifying the crap out of a portfolio to protect ourselves. All the air in tech is draining. This is good. Yeah, I honestly think we're going to head into a domino effect. I don't think it's appropriate in this current environment for companies like Microsoft, Apple to be trading at 30+% multiples. When Facebook dropped, I think in the long term, I think Facebook's going to do great. But in the current environment, if we're only getting 8% growth on the low end, honestly, the PE ratio at this level is a lot more reasonable. Like I said, if your company is like Tesla, okay, or Nvidia, let's use that as an example, right? These companies are growing at 30 to 50% growth rates. I don't mind paying a super high multiple for a company that can grow at a 50% clip. And if I can predict that it's going to keep doing that, I don't mind overpaying for it. I really don't. That's why I like Facebook. I thought it was insanely cheap at the PE it had, but I also didn't think that they could see that much revenue drop. I honestly thought if we went into another period where people weren't buying iPhones as much, then everyone's still going to be using Instagram and Facebook to the same degree, right? But it gets a little concerning. Like I said, that was by far the worst earnings report I have ever heard out of Facebook in the entire history I've owned them. And I've owned Facebook for a very long time. Like I've owned it long enough that my average cost on it was like 210, but most of my buying was in the 170s. And even the shares that I sold, I made a profit on. I mean, I've been in these companies for a very long time, man. And honestly, I want them to drop. I am waiting. If Amazon goes through Q1 and they only post like a 3% growth there and they drop off 10, 20, 30%, I am every day of the week buying it. Every day of the week. Because like I said, man, you want these markets to come down because that's when you're going to make your most money over the long term. Why does Enbridge always have such a high yield? What a catch. Yeah, Enbridge is incredible for anybody that picked it up. I never bought into it. I underlooked it when it was at its lows. And I still think it's a good buy here, depending on what you're looking for out of your portfolio. Because I mean, if you're in Canada, I mean, just go to any mall strip, go to any like public housing where you can walk beside it and go look at the natural gas or the intake lines. You'll see that they always have an Enbridge logo on them. So I mean, like Enbridge has such a foothold in this market that I think it's just like the utilities, though. I look at Enbridge as a utility. I wouldn't be buying it for growth as much as I would be for sustainable yields. But Facebook does nothing, man. Fluff, in my opinion. I think you're underestimating that when it comes to VR, AR. I mean, you're talking about a company. Look, if you're buying Tesla and you think Facebook is weak, I think you got your head a little mixed up because if I had to pick one company today to outright own, I think I would rather own Facebook at the current valuation. Because Facebook is investing heavily into the future. And I want to own companies that have foundational businesses that are investing heavily into what I think is going to be a big deal. I think AR, VR, NFTs, and crypto are going to be a big deal. Luckily, Facebook agrees with that statement and they're investing tens of billions of dollars into it. Just like I think what Elon Musk is doing with robotics, self-driving, supercomputers, which by the way, Facebook's trying to build the fastest supercomputer on the planet, competing with Tesla and Google. I mean, I love that. That's what I want. I want people investing because you're going to get a return on capital over the long term. Dividends aren't always the best return on capital. Unfortunately, I might not be the best investor with my dividends, but I think Facebook, I think Tesla are going to invest that money better than I am. So I would rather have them invested into my future, being robotics, AI, computers, because that's where I think the future money is going to come from. So, I mean, I don't mind all that. Tesla sucks. It's all hype. I personally disagree. If you know anything about the auto industry, you're going to have a rude awakening, my friend. People look at the Meta investment as just dead money, but it's dead money right now until we get more assurance out of the market. But long term, I'm still bullish. I still like Facebook. I bet there's a slight rip in Facebook after the FFO Fighters versus concerts, after the Super Bowl. Great marketing. Yeah, I mean, we're just starting to get virtual concerts now. I don't know how many of you use the VR, but I mean, I'm using this stuff 3 days a week and I love it. I'm obsessed with it, to be honest. It's a great way to interact. I'm using a lot of facets and the utilities that it offers. Smart centers. What do you think? Oh, smart centers. So I just referred to that early in the stream. When I was comparing Ryokan, saying that, look, like you don't know what you don't know. And I fixate on Ryokan, but if you bought smart centers at the same time I bought Ryokan, you'd be in the same position today. There's no difference. So I'm actually thinking about, I want to get through earnings first because I'm a little bit scared about these REITs for two things. They're lying about their numbers. They're cooking their books. Okay, let me not say lying. Let me be careful what I'm saying here. So look, smart centers and Ryokan, I've highly fixated on for quite some time now. And what I've come to realize is that they're trying to offload the scarier part of their portfolios, which is obviously apparel, anything that's exposed to those markets that are getting crushed through the pandemic, movie theaters. But when you looked at the pandemic, their rents dropped down to about an 80 to 85% rent collection. Actually, I think some of them dropped as low as 70% or somewhere in the mid 70s. And now, when you look at the recent presentations, they're saying that their rent collection has gone up and it's almost back to the sustainable 98% range. But that isn't accurate because what they've done is offloaded tenants and sold properties. And when you get rid of the property and the tenant, yeah, your total rent collection from everybody you're renting to looks like it's going up. But when you look at the actual revenue and their bottom line, like funds from operation, they've actually decreased. So there's a bit of concerns that I have with that, and I just want to pay attention because I really like the logistics industry still. I really like Canadian apartments, anything that's really exposed to the residential markets, and that's another reason that I like Smart Centers and RioCan because they're largely pivoting into residential, and I think they're going to get a lot of growth out of that in the coming years. The problem is in the macro term, I just want to see how they're getting hit because Canada went through another lockdown. Unlike the US, I mean, a lot of people haven't left their homes for like the last couple months because I mean through January we've been in lockdown periods and a lot more fear is people have been getting sick, right? But I think we're hopefully over that last hurdle. So what I plan on doing is actually selling down RioCan and I'm looking at actually buying into Smart Centers and I'm looking at a few other ones, kind of like Dream Industrials one. I'm also looking at Canadian Apartment Properties Trust. But I do like those. And like I said, this is just purely out of divesting and trying not to be overexposed in a market where I'm kind of more fearful than I have been in the past. Thank you for your answers and all the questions. Please make a video about CNR. Yeah, I'll try and get around to it. Then why isn't RioCan bringing back their previous dividend? Actually, I would prefer that they didn't. So when you look at Smart Centers, what they've recently done is they've done more share dilution. Smart Centers has been raising capital, and that's kind of how they've been kind of cushioning themselves because they pay out all of their money. Right now, so Smart Centers, I looked at their adjusted funds from operation versus their payout. Yahoo Finance doesn't show proper payout ratios. I hate Yahoo for payout ratio, but because I think Yahoo says it's like 98%, but it's not. I think with Smart Centers, their payout ratio right now is about 88%. So they don't have like any leftover cash to invest, to pivot, to do anything. So they're stuck selling properties. They're stuck doing share dilution, which they just did a recent period of. Whereas RioCan, I listened to the earnings call and I really like where the because you got to remember in RioCan, the recent CEO just dumped out. So the recent CEO, the old school guy, he's gone. I mean, he left, and a younger guy that's a lot more aggressive took over the company. And they did cut the dividend, but now their payout ratio is only 75%. And they're looking at using that capital to reinvest it and try and offer more growth. Because you might remember Smart Centers and RioCan, their stock price hasn't grown in decades. They haven't hit all-time highs in decades. They're purely cash flow machines, but I think RioCan, because of the new management, there's good potential for growth because they want to retain some of that capital to keep kind of taking advantage of the market as they divest their portfolio. And honestly, it offers a lot more security to the dividend because, you know, if we go into a period where we keep losing rental income, inevitably Smart Centers will have to cut that dividend. I mean, they're really close to the bleeding edge. And a lot of these guys, again, are lying about the numbers because they're selling off properties to generate cash. So you got to be careful. REITs are a hard thing to wrap your head around. They're not as clean cut as Facebook is. Like I can look at Facebook and Apple and understand their company literally within 5 minutes. If I look at a REIT, it takes a long time to fully wrap your head around about how they're taking advantage of share dilution and a lot of other metrics. And RioCan even said in the future they might re-increase the dividend, they might do share buybacks, but for right now, in the volatility of the market, they just want to secure our investments. And I agree with that. I like the new management. I think RioCan's going to do just fine because of that. Commodities looking promising for the next few years. I think commodities are great. They're a little bit more cyclical, but in this market, look at oil, look at gold. A lot of the gold stocks are starting to come back. Look at any of the commodity stocks. I mean, a lot of them are pumping to the moon right now. I mean, ExxonMobil hit it. It's up. If you told me that Exxon would be sitting where it's sitting today, I probably wouldn't believe you. I'm kind of blown away by the growth it has. Yeah, payout on RioCan is really low right now. They got lots of room, lots of room. What else we got going on here, guys? VRE, REIT ETF. So I like the REIT ETFs outside of Canada. Personally, I don't. It's like the bank stocks. There's only a handful of large cap REITs that I really want to own. I don't like the smaller caps. I don't like the more volatile, riskier stuff. I like holding large caps. So I'd rather pick 4, 5, 6 real estate investment trusts. GRT is a great one. Dream Industrial, Smart Centers, RioCan. There's so many, man. Like Canadian Apartment Properties is great. I know some people like H&R is another one, but I'm not the biggest fan of that one just personally. I don't really like the heavy office exposed REITs, but again, look at something like TNT.UN. True Properties North or whatever, their only office, they're a small cap office REIT paying like an 8 or 9% yield, and they survived the pandemic purely being an office REIT. Like if you thought office was dead, go look at that small cap REIT because it is just printing money to anybody that bought it in the dip. I use Jeppy as covered calls. Yeah, so my problem with covered call ETFs, let's say, is I think people underestimate the stability of them because I've been looking at a lot of covered call ETFs lately, and I don't think people realize, and I don't know about Jeppy, I'd have to look into Jeppy, but I've noticed that a lot of the covered call ETFs, their stability in the dividend is gone out the door in the volatility of the market. I don't think people understand that, like, covered call ETFs do a lot better when the market's stable rather than volatile. So I've noticed that the dividend payouts have actually been getting cut through a lot of covered call ETFs. I like them. I think if you want to own a bit of them for cash flow, they're great. I just don't like them long term for anybody that's got a 20 or 30 year time horizon. I just don't think they're fully appropriated because there's just other risk factors, and you tend to underperform the market always. It's very hard to outperform the market owning covered call ETFs. DVN, fat dividend, yeah, volatility changes, options premiums, 100%. You got to be a little bit careful with that. And like I said, in the last year or two, when we've had nothing but an uptrending market, it made them look better than they were. And now people might realize that they're, because if the market goes down, they go down with it almost. TNT mostly government tenants, 100%. TNT crushed it. They might run into issues. I don't listen to their earnings calls, but I've been really impressed by them. There's a few other small cap real estate investment trusts in Canada. Now, keep in mind, I primarily stick to the Canadian market, but if you want one really good REIT, and I've been like rolling around on the floor about this, is MPW. MPW is probably one of the best structured real estate investment trusts I've ever seen in my life. They're a little bit smaller cap, but they're purely exposed to hospitals at a triple net lease structure with inflation baked in at 2%. Now, keep in mind, like, we're in a period where inflation's at 7%, but basically what that means is they can increase the dividend every single year because the rents are baked into the lease agreements. So every year the rents go up 2% with inflation. I wish it was 7, but you could take what you can take, right? And the fact is I think hospitals are more important than ever. They're globally diversified. They pay a great yield. Unfortunately, it's quarterly. It's not monthly. But honestly, I love MPW. I think I've got a decent little exposure to it. I wish I could buy more of it, but at a risk tolerance, I don't want to over leverage anything right now. But I love that company along with Stag Industrial and MPW. Oh God, those REITs. It took me a while to find them, but I think they were some of the best decisions I've made. Have you ever looked at the Plaza REIT, Kyle? See the construction all around my city, such as small caps, 5% yields, and rebounding nicely. Yeah, I mean, go ahead with small caps. I think there's a lot of opportunities in those kind of companies. I just don't personally like small cap REITs. I'm a large cap investor only, man. If I'm buying small caps, I'm really only picking like one, and usually they're highly risky because I like playing like higher risk investments for smaller caps. I just don't like them as long term holds. It's just personal preference, guys. I look for stability at scale, and that's why I like Tesla. That's why I like Facebook and Apple and Microsoft, and I love large cap REITs. I always stick to large cap companies because the percentage rating of you losing money over the long term gets greatly degraded. Whereas, I mean, go look at small cap companies over the last year. I mean, you're down 80%. I can't see large caps like RioCan or Bank of Nova Scotia dropping 80%. I just can't see that in my lifetime. And they have technically better footholds in the economy. You're not getting that kind of growth that you want. But again, I'm in a different position than most people because I don't need to make 30 to 50% every year on my portfolio. I'm not chasing the higher returns like I used to. I'd gladly be happy with a 5 or 10% return. If I get a 5 or 10% return on the money I have, guys, that's a full-time income, right? So, I mean, like I said, I'm in a bit of a different position from the way I think about my investing style right now. Banks are sells too. Sell financials, high CPI print tomorrow. Yeah, I mean, there's risk. But again, think of it this way. If rates go up, banks do better. I was actually just talking to my bank today, and I had this discussion because I'm looking at putting my emergency fund in a high interest savings account, and it gets very confusing. The high interest savings accounts today are really confusing. I'm looking at GICs right now. But the thing with it is I told her, because they want you to lock your money up for a period of time. You can pull it out whenever you want. But if you want the premium to get like 1.5%, you have to lock it up usually for 12 to 18 months usually. And it's because it's emergency fund. That's probably what I'll end up doing with it, and just never touching it in case something really bad happens. But the problem with it is I asked her, I said, well, what if interest goes up? Because I mean, if interest rates go up, your premium that you're going to be offering clients will also go up. And I said, well, what happens if that happens? She says, well, these are locked in periods. So you're going to have to open up another account if interest goes up and you want to take advantage of a higher interest rate. That's why I like banks in an interest raising environment. They make more money. So that's why bank stocks have actually been going up. Now, again, it gets scary from the leverage perspective because banks are highly leveraged into real estate, which I talked about earlier. 10 is great for me. The margaritas on the beach. Let's go, baby. Take a drink, take a breath. For sure, for sure. Do nothing for a bit is a good idea. That's my plan, baby. I'm index funds, dividends, decreased my risk. 27% of my portfolio is in now large cap tech. That includes Bitcoin. So I've deleveraged from, I think, about 31% down to 27% in tech stocks and growth stocks that don't pay dividends. I redivested that in. Oh, like I said, I'm going to do a whole portfolio reveal soon. I just want to get to REIT earnings and bank earnings, but I'll do it at the end of this week and show you guys what I've done. Because like I said, I'm not out of the market. I'm not pulling a meet Kevin. I just understand that I don't think I need the risk of having 8% of my portfolio in one individual asset in this market. Can you switch stocks and RSPs to TFSAs without avoiding tax? You can't pull money out of an RSP in any way without being taxed. Once that money's in there, it's deferred capital and you will have to withdraw it by paying withholding tax, which just counts toward regular tax anyways. I did watch you for a while, man, and I'm really impressed at smarter you are right now. Yeah, like I said, it's a growing learning lesson for everybody, right? Like I'm not a genius. I take everybody's perspective into strides, and I can only do what works for me. And the reason that I'm transparent about that is because I think me showing transparency about the growth that I've had since I started this channel, I just offers a different perspective. But I think all perspectives matter, right? Like don't do what I'm just doing. I've never bought real estate. If I was smart, I would have bought real estate. I'd be way better off right now. So I mean, listen to everybody. I listen to Grant Cardone, Ben Mala, Meet Kevin, Graham Stephan, Everything Money. Like I listen to everybody, and I don't invest like they do, but we all have our own styles, right? But you can't learn unless you take it all into perspective. Can you go over why you didn't like CAD hedge securities? I hold VFV. It's purely because of diversification. I talked about this before, guys. I know a lot of you don't like converting capital, but I don't like holding foreign investments in one currency. If you really want a divested portfolio, you'll learn multiple currencies matter. I mean, it's so hard to wrap your head around, and I know it gets really confusing. I've been doing it for years now, so I've become more comfortable with it. But when I own a US asset, I want to get paid in US dollars. And when I sell that asset, I want to get sold out in the native currency of US dollars. It's just smarter. It's more diversified. Same thing with Europeans, guys. If I could buy European stocks, I want to buy them in the euro. I don't want to buy them in a Canadian dollar CDR because you're not really diversifying yourself that greatly doing it. Being exposed to one currency, I wish I could pull it up right now. You want to talk about currency risk? If you only held Canadian assets from, I think, 2015 till about 2020, you lost about 20% of your net worth to the currency dropping dramatically. People don't understand holding currency is risky. That's why I don't care about volatility. Because if people understood how volatile their currency was, I think they would be a little less fearful of a 30% correction in a stock. Because again, guys, Canadian dollar has been really volatile and has dropped a lot. So, I mean, if you've only held Canadian assets, you might think that you're up in your stock portfolio, but you have to take into consideration that you've lost purchasing power. It's weird because some banks show this. My Bank of Nova Scotia does not show me currency conversion. However, my Royal Bank account actually shows me the dollar loss value. They show me the day I make a purchase in an asset. Because I'm outside of dollars now and I'm in a physical business, if that dollar moves up or down, when I sell that asset, it'll actually change the value of it. It's a very confusing concept, and it's something that is largely overlooked by people that are stuck in their own little bubbles. Like if you only live in the US and you only operate with US dollars, you would have never even thought about that. Same within Canada. Like if you only look at that $1 rate, you completely forget that you're not really diversified against currency risk. So I have like almost a 50-50 split. I got about, maybe I think I'm about 60-40. I think 60% of my assets are US dollars, 40% Canadian dollars. Facebook has some serious problems. I would agree. I'm not going to lie to you. That was the worst earnings call I ever heard, but I do not want to repeat myself, man. So instead of, reworking this conversation and having this kind of circled conversation, if any of you want to learn more about what I talked about, go back to the beginning of this video, watch it over. But I just don't want to circle here because I feel like we're going to be going into a rounded conversation again about Facebook and the same stocks we talked about. So in light of this, folks, I hope you enjoy the conversation. Stay cool, stay awesome, and be diligent.